If you're watching the markets lately, you've seen the volatility that's been brought on since the start of the year, and consumer confidence is dropping, and the market is signaling recession fears while inflation is actually back on the rise. US consumer confidence has taken a sharp downturn lately, raising fears that a recession may be on the immediate horizon. And the Conference Board's Consumer Confidence Index fell by 7 points in February, marking the third consecutive month of declines. And this drop was the largest since August of 2021, and it fell below economists' expectations. Now, following this report, stocks and bond yields declined, reflecting broader market anxiety and concerns about the job market, personal earnings, and business growth are all on the rise. Inflation expectations have actually surged as well, as Trump's tariffs are adding financial worries of a full-blown trade war, and there's now talk of further Fed rate hikes, which will make borrowing more expensive and debt servicing unbearable for many American households, which are already being crushed under record credit card debt. And this economic anxiety has already begun to impact consumer behavior. A Wells Fargo study shows that uncertainty is making Americans hold off on any big purchases, and that 1 in 8 workers, in fact, has postponed retirement plans. Now, meanwhile, the stock market is showing signs of significant stress, with the Magnificent Seven actually falling into correction territory, and this comes after a 2-year rise of 54%, which many economists view as very unsustainable. This group of stocks has already lost $1.6 trillion in market value, with Tesla, of course, leading the charge, down 37%. Now, Treasury Secretary Scott Bessent stated that the U.S. private sector has been in a recession already. He blames the Biden administration, saying that his policies put government growth ahead of private industry. And he argues that government spending created the illusion of strong economic metrics, but that the real economy was turning brittle underneath. And Bessent noted that job growth occurred primarily in government, education, and healthcare, while meanwhile the private sector job creation had slowed, adding fewer jobs in 2024 than what they did in 2023. And he warned that excessive government spending distorts the economy, it inhibits innovation, and it limits growth in many sectors. He states that this is about more than just reducing fiscal deficit, but that this new administration's goal is to re-privatize the economy, creating more balance between public and private sector growth. Now, several key recession indicators are firing off right now, suggesting trouble ahead. Morningstar, which is a key investment research firm, includes all of the following as key signals of a looming recession. First, they look at the inverted yield curve. The yield curve has been inverted for more than 2 years. It turned positive at the end of 2024, and past data shows that a recession often starts within 6 months after yield curve inversion ends. And the stock market is declining. On February 21st, 2025, the Dow Jones plummeted. It dropped 748 points, marking its worst day of the year. We're also seeing a major decrease in home sales, and existing home sales have fallen more than anticipated in January of 2025, and that trend is expected to continue. And then we have inflation worries. In February, the University of Michigan's Consumer Sentiment Index fell by 10%, and that drop was primarily a result of fears about inflation. So we have independent economists that are painting a very grim picture of the economy and the coming recession. Primerica believes that there's over a 50% chance of recession in the next year, pointing to issues such as war, trade disputes, and political instability. And a Raymond James analyst is also estimating a 40% chance of recession. Now, fears of trade war reminiscent of the Great Depression, along with AI-driven volatility in the stock market, are adding to those concerns. And with investors caught between rising inflation and a potential recession, retirement funds are certainly at risk. History has shown that during times of economic uncertainty, people tend to flock to long-term protection against market downturns. And so if you're concerned about potential recession and current market volatility and you're looking for a way to diversify and hedge against your fears, I'm Mackay Block with American Hartford Gold. Give us a call today and we'll discuss how adding physical precious metals into your portfolio can give you the hedge that you need.
Discover how gold can help you protect yourself and your family. Call today or visit our website for more information at AmericanHartfordGold.com.